What's going on, everyone? Welcome back to the channel. Today I'm going to be describing to you what bonds are, why they're used, give you a good examples of how they're used in the marketplace to provide returns for investors. I'm also going to give you a brief way to evaluate bond prices to determine the value of each bond given, interest rates, number of periods, etc. So let's get started. So bonds are essentially tools used to raise money for either federal governments or corporations. And essentially, it's a loan that the investor is giving the respective entity so that they may finance projects that they want to pursue. In return for your loan, they not only agree to pay you back the face value of the loan, which in other words is the amount of money you loan them on a specific date. They also pay you periodic interest payments along the way. And these interest payments, they're usually semi-annually or, once every 6 months. They can also be every year. It all depends on the bond you're purchasing. Bonds are also usually held over a longer period of time and provide less returns on average than the S&P 500. However, they are less risky investments, and just due to the fact that you're promised a guaranteed sum of money in the future. So, I italicize main in this title because there are hundreds of different kinds of bonds that exist, but these are the main types of bonds. And I also think it's important to discuss the risks that are associated with these types of bonds. First, we have corporate bonds, which are issued by a corporation when they want to raise money for certain projects or endeavors. Corporate bonds are exposed to default risk. Depending on the financial health of the corporation, the default risk is essentially the risk that the underlying corporation won't be able to eventually pay back the principal loan or interest payment. If you have some really early corporation that's trading at, $2.50 a share that, isn't able to generate a lot of cash flow, that's definitely going to be a more risky investment in regards to default risk in comparison to like a United Health Group, a Medtronic, like an Amazon, all these companies that are able to generate a plethora of cash. So yeah. Next, we have municipal bonds, which are otherwise called munis. These are issued by state and or local governments. You know, uh, in the state where I'm from, a lot of municipal bonds are used to develop infrastructure. Any kind of project that a state may have, they'll issue municipal bonds. And the cool thing about municipal bonds is that income from these bonds are tax exempt from federal income tax and also sometimes state income tax too. These are really attractive for high net worth slash high tax bracket individuals. Especially if you're closer to retirement, you're going to want to have some money in municipal bonds just because the interest or capital gains you're getting from these bonds are completely tax exempt from federal income tax. Next, we have treasury bonds, which are issued by the federal government. This is the most liquid bond that exists, and these are essentially not, it's up to debate, but there really is no default risk. You can make an argument about, given the economy, the climate of the economy, whether the actions of the Fed, tampering with the money supply, what inflation's like, you can really make an argument for the fact that, in the worst case scenario, there could be default risk by the federal government, but usually there isn't going to be, and there hasn't been, at least to my knowledge, any history of default risk on any, T bond that exists. Next, we have foreign bonds, and these are simply bonds that are issued by a foreign government or corporation. Not only is there default risk that exists, but there's also currency exchange rate risk. This can mean that, if your currency loses value, you're ultimately losing money on your investment. So just keep that in mind before investing in any foreign bonds. So some important features and terms of bonds. First, we need to go over the par slash face value. This is essentially the amount of money that you're going to be loaning either a government or a corporation. This is the money that is borrowed and promised to be repaid to you on the maturity date. And the maturity date is essentially the date in which the bond expires or the principal value is paid back to you. Next, we have the coupon interest rate. This is the annual interest rate that's usually fixed that is paid by the issuer of the bond. The equation for this is the coupon interest rate times the par value, which is going to be your coupon payments that you get for the pre-agreed periods. Next, we have the maturity date. This is the years or periods until the bond must be repaid. Also, we have yield to maturity, YTM. This is otherwise known as the promised yield. This is the rate of return earned on a bond held until maturity. Next, we have the term, which is simply just the time period on the bond. How to value bonds. Essentially, I like to break this down into words before I go into the math, but the bond value is the present value of equal interest payments plus the present value of the repayment of the bond's principal. If any of you guys are confused about present value, please watch my NPV explained video. Essentially, present value takes into consideration the time value of money, or the idea that a dollar today is going to be worth more than a dollar tomorrow due to both the fact that inflation exists, which essentially means that your dollar or whatever currency is losing value over time, whether that be through money supply done by central banks, or just whatever the inflation rate is in the country that you reside in. Furthermore, the time value of money also pertains to the idea that if you were going to put that singular dollar to work today, investing it, it will be worth more in the future. So present value takes in consideration the future cash flows or interest payments into today's money. So this is the math right here. All you need to know is that the value of the bond equals the interest payment over 1 plus RD, which is going to be your coupon rate, and then you put it to the exponent of the time period. These two fractions right here, with that's signified by this ellipses, these are going to be adding up all of the periods. So you see here, interest payment over 1 plus RD to the n, plus finally the maturity or the par value over 1 plus RD to the n. So essentially what you're going to be doing is you do value of the bond, which is in question, equals all of your interest payments over 1 plus the interest rate to the number of periods. And then at the end, once you add all those up, you add over or plus the par value over 1 plus RD to the n. Because at the end of the maturity, you get your initial principal value loaned back to you or paid back to you. Here's an example. What is the value of a 10-year, 10% annual coupon bond if the interest rate RD equals 10? So you look here in question, we're looking for the value of the bond. After period 1, you get $100. After period 2, you get $100, etc. However, when you do the math, the value of the bond equals $100 over 1 plus 1 to the first. You take into consideration all 10 periods in the question. This is going to be years, plus finally $1,000 over 1 plus 1, 1.1 to the 10th. Essentially add all this up, the value of the bond is going to be $1,000. Other thing to know about bonds are that they are rated by rating agencies whose job is to rate bonds so that investors can be well informed. The big three are Moody's, Fitch, and S&P. Essentially what ratings serve as a guide to the probability that a bond may default. Both, sovereign governments and corporations are given ratings by rating agencies. The one thing that's also important to consider is that investment grade or the higher quality, higher rated bonds are going to give you a lower interest rate, just because there's a higher chance that essentially there isn't a chance that they're going to default. So they're able to say, I'm going to give you a lower interest rate, but you are definitely going to get your money back, your par value back at the end of maturity, the maturity date. However, junk bonds, in a way, it's kind of misleading. Not all junk bonds can be considered, truly bad investments, especially if the corporation is younger and just doesn't have, as many years of returns or a lot of financial data available for investors to analyze, but essentially junk bonds are going to give you a much higher interest payment, but there's also that higher risk that the coupon value, or I mean the par value of your bond is not going to be paid at the maturity date. So just something to keep in mind. Also, another thing to keep in mind is that it's also important to be wary of rating agencies. Really do your homework on the company, the government, look at the data, that you're interested in investing in. A big example of rating agencies kind of going bad was in 2008 when, all these big investment banks essentially paid all the rating agencies to give their mortgage-backed securities, really high investment grade ratings when in fact they were just terrible investments. Furthermore, rating agencies are for-profit institutions. So essentially, the the corporation that pays them the most, they're going to be giving them the highest rating possible. There's an incentive to give higher ratings based on compensation. If you want to watch some movies on this, The Big Short is always a great movie to watch. Also, the documentary The Inside Job is also really, really well done. I think it won an Oscar. But these essentially provide really good examples of how detrimental inaccurate ratings could be. So thank you for watching. I hope this helped. Again, this is a very, very introductory, lesson of what bonds are. If you want to see more on bonds, or any kind of finance terms explained, please let me know in the comments. I hope you guys have a great day. Thank you.